Today, we're moving into the 1990s, a decade when Buffett's letters became even more structured, more pointed, and more revealing. The 1990 annual letter was shaped in part by the Salomon Brothers scandal, which pushed Buffett to talk not just about investing, but about culture, governance, and the danger of doing business with large, complex financial institutions. In other words, this was no longer just a letter about returns, it was a letter about how fragile good behavior can be inside big organizations. And at the same time, Berkshire was entering one of the most important phases in its history. In the early 1990s, the US economy went through a short recession, a credit crunch, and an oil shock. Berkshire's stock had a rough 1990, but then the next 2 years became some of its strongest. So in this period, we can really see how the economy and Berkshire's long-term compounding story moved together. The recession began after a long economic expansion finally ended. Interest rates had been pushed up in the late 1980s, which slowed the economy, and then the 1990 oil shock after Iraq invaded Kuwait made everything worse. Banks were under pressure, real estate was weak, and many businesses were hit by falling demand and tighter credit. The recovery that followed was weak, and unemployment kept rising even after the recession officially ended, the classic jobless recovery. For Berkshire, 1990 was a painful year. The stock fell sharply, and book value grew only modestly. Buffett explained that the company's big stock holdings had stopped carrying the same momentum they had in earlier years. Media businesses were facing more competition and weaker pricing power, insurance underwriting lost money, and the overall environment for risk-taking had become tougher. But the important point was this: the businesses themselves were still strong, even if the stock performance looked disappointing in the short term. Buffett kept stressing that Berkshire's real strength was not speculation. It was ownership of excellent businesses run by excellent managers. Companies like See's Candies, Nebraska Furniture Mart, Borsheim's, and Scott Fetzer were still producing high returns with very little debt. Buffett and Munger's job, as he described it, was simply to treat these managers well and allocate the capital they generated wisely. That's a huge part of Berkshire's edge. Not control through micromanagement, but discipline through ownership and trust. Then 1991 arrived, and the story changed dramatically. Berkshire's book value jumped, and the stock surged. A big part of that came from Coca-Cola and Gillette, whose market values rose significantly as investors reappraised the strength of those brands. At the same time, the broader market was recovering, and financial stocks were being re-rated after the panic of 1990. Buffett still warned about weak media earnings and insurance costs, but 1991 showed how powerful Berkshire's model could be when high-quality businesses and patient capital were both working in the same direction. In 1992, Berkshire continued to compound strongly. Buffett emphasized look-through earnings, which is a very important concept for understanding Berkshire. The real earnings Berkshire owns are not just the dividends it receives, but also the retained earnings of companies like Coca-Cola and Capital Cities, even when those profits never show up directly in Berkshire's cash flow. He also made clear that insurance remained one of Berkshire's biggest opportunities, especially in catastrophe reinsurance, where the business can be volatile year by year, but highly attractive over time if priced correctly. What stands out across these letters is that Buffett was not changing his core philosophy. He was sharpening it. The 1990s letters gave his ideas clearer structure, stronger language, and more concrete examples. And through the Salomon crisis, the recession, and Berkshire's own ups and downs, Buffett kept returning to the same foundation. Culture matters, incentives matter, and great businesses compounded patiently are far more powerful than clever short-term moves. One of the most striking lessons from this period is Buffett's view on retiree medical obligations. He and Munger avoided buying companies with heavy post-retirement liabilities, which helped keep Berkshire's own obligations tiny, despite having tens of thousands of employees. Buffett had nearly made a dangerous mistake years earlier when he almost bought a company with huge retiree healthcare commitments, but the deal fell through. That experience reinforced a brutal truth. Open-ended promises can become a silent balance sheet trap, especially when management ignores them because they do not show up as immediate pain. By the mid-1990s, Buffett's letters were also showing the cost of mistakes more openly. In 1994, he admitted to major errors like selling too early in one case and making a poor airline investment in another. That honesty is part of why these letters are so valuable. They do not present Berkshire as perfect. They show how even a great investor can make unforced errors, and why avoiding bad capital allocation matters just as much as finding good opportunities. So when we look back at Berkshire in the early 1990s, the real story is not just the numbers. It is the way Buffett turned crisis, competition, and accounting detail into a clearer investing framework. Berkshire was becoming more than a collection of businesses. It was becoming a machine built on discipline, trust, and long-term compounding. In 1996, the United States economy was quietly strengthening. Real GDP grew around 2.4%, unemployment hovered near 5%, and inflation remained low and stable. Yet while the real economy moved at a steady pace, the stock market surged ahead, with the Dow climbing more than 20% for the year. Against this backdrop, Warren Buffett reminded Berkshire Hathaway shareholders that he and Charlie Munger viewed them as partners. Their own wealth was overwhelmingly tied to Berkshire stock, meaning they truly ate their own cooking. Berkshire, he emphasized, existed to make money with shareholders, not off them. That year also marked a major milestone. Berkshire completed the full acquisition of GEICO. Although accounting rules required Berkshire to write down certain elements of the purchase, creating what looked like a reduction in reported value, Buffett made it clear that no real economic value had been lost. In fact, GEICO's intrinsic value remained intact and continued to grow, highlighting the gap between accounting optics and business reality. At the same time, Berkshire expanded its collection of high-quality operating businesses by acquiring Flight Safety International, a leader in aviation training. This was a classic Buffett move, buying a dominant, well-managed company with durable competitive advantages and strong long-term demand. Buffett also revisited Berkshire's earlier investment in US Air, using it as a contrast. While the preferred stock investment ultimately worked out financially, he acknowledged the uncertainty and challenges in the airline industry, reinforcing a key lesson. Even when an investment produces a decent outcome, it doesn't necessarily mean it was a great business to own. Throughout the letter, Buffett stressed that Berkshire's real strength came from its underlying businesses and the insurance float they generated. He also encouraged shareholders to think in terms of look-through earnings, which include the retained earnings of major investees like Coca-Cola and American Express, not just the dividends received. In a market full of noise and rising prices, Buffett's message was simple but powerful. The best strategy is often inactivity. By holding wonderful businesses at sensible prices, investors allow compounding to do the heavy lifting. As he famously noted, Berkshire often made more money when they were snoring than when they were active. While Wall Street chased short-term gains, Buffett urged investors to focus on intrinsic value and long-term ownership. The key question was not whether a stock might rise tomorrow, but whether it was worth owning for the next 10 years. The Federal Reserve described 1997 as another excellent year for the U.S. economy, with strong growth and improving labor market conditions. The biggest thing in Berkshire's 1997 shareholder letter was Buffett's warning that stock prices had become much less attractive. The margin of safety had been eroded by the booming market, even though Berkshire's businesses were still performing well. 1997 was the year Buffett said the market was getting expensive, so Berkshire's edge would come more from patience and business quality than from buying aggressively. A second major point was Berkshire's strong underlying performance. Net worth rose by $8.0 billion in 1997, and Buffett used the letter to reinforce that Berkshire's real engine was insurance float, look-through earnings, and long-term ownership of great businesses. Buffett also paused to reflect on Coca-Cola, where the death of Roberto Goizueta reminded him that great businesses still depend on great leaders. Goizueta had helped create enormous shareholder value, and his death raised the question of whether Coke could maintain that standard under new leadership. In the 1998 letter, Buffett spent a lot of time explaining accounting distortions and why Berkshire wanted managers to think about economic reality, not accounting optics. The big idea was that Berkshire did not want its managers making decisions to flatter reported earnings. Buffett said he would rather disappoint shareholders with earnings than with accounting, and he criticized things like restructuring charges and other accounting tricks that can make results look better than the business really is. Buffett said the General Re deal exposed a flaw in accounting because it could make Berkshire's economic reality look worse on paper than it really was. The 1998 General Re accounting issue remains a textbook example of Warren Buffett's lifelong battle against rules that value appearance over economic substance. By forcing an artificial pension charge onto the income statement, rigid GAAP guidelines distorted the merger's true earnings power. Ultimately, this event reinforced Buffett's message to investors. Always look past superficial accounting entries to focus on the underlying economic reality. His broader message was that managers should focus on what counts, not on how it will be counted. In Berkshire's case, he argued that accounting should not drive business decisions, and that shareholders should judge the real economics of the deal rather than the reported numbers alone. Buffett also argued that stock options are a real cost and should be treated that way in economic analysis, not ignored just because accounting rules made them look less visible. His broader point was the same as with General Re. Accounting can understate the real economic burden of a decision. Options may not always show up as an immediate cash expense, but they dilute owners and transfer value, so Buffett wanted shareholders to think about the true cost, not the reported optics. He focused on how CEOs used restructuring charges and acquisition accounting to legally deceive shareholders. 1. The Big Bath manipulations. Buffett exposed how companies deliberately over-recorded massive, one-time restructuring expenses during mergers. The tactic. They created massive reserve funds on paper. The goal. They used these bloated reserves to pay for ordinary, day-to-day operating expenses in later years. The result. Future earnings appeared magically higher and beautifully consistent. 2. Regulatory and auditor failure. Buffett expressed deep disappointment that Wall Street auditors, boards, and analysts tolerated this behavior. Auditor compliance. Accountants routinely approved these maneuvers because they technically followed GAAP rules. Institutional silence. Wall Street smiled at the deception because it helped companies hit their projected quarterly earnings targets. 3. The core conclusion. Buffett famously summed up the systemic issue by quoting journalist Michael Kinsley. The scandal isn't what's illegal, it's what's legal. In 1999, at the height of the dot-com bubble, Warren Buffett did something almost unthinkable. He gave himself a D in capital allocation. Berkshire Hathaway had just delivered one of the worst performances in his entire career, bad in absolute terms, and even worse compared to the S&P 500. While tech stocks were soaring, Buffett looked obsolete. But this letter wasn't an apology, it was a warning. Buffett didn't hide behind excuses. Berkshire's per-share book value increased by just 0.5%, a rounding error compared to the market's explosive gains. He compared himself to a quarterback failing his classes and said plainly, the responsibility was his, and his alone. This is important, because most CEOs blame macro, cycles, or one-off events. Buffett didn't. He focused on what actually mattered, capital allocation decisions. And he admitted something even more uncomfortable. Several of Berkshire's biggest holdings simply underperformed operationally. No story, no spin, just reality. Then Buffett shifts from confession to prediction. He tells shareholders something they didn't want to hear. The extraordinary returns of the past, especially from 1982 to 1999, were not normal, and they would not continue. In fact, he said he had virtual certainty that future returns would be far lower. Why? Valuations were stretched, expectations were unrealistic, and most importantly, math. You cannot compound at extraordinary rates indefinitely when starting from high prices. At the same time, he resets expectations for Berkshire itself. The company had become too large. Opportunities were fewer. Cheap businesses were scarce. Outperformance wasn't impossible, but it would be much harder. So why didn't Buffett just buy tech stocks like everyone else? Because he didn't understand them well enough. He couldn't confidently answer a simple question. Which companies would still dominate 10 years later? In fast-changing industries, competitive advantages are fragile. Buffett chose discipline over popularity. And in 1999, that looked like a mistake. After a painful experience issuing stock in the General Re deal, Buffett made a clear shift. Future acquisitions would favor cash over stock. Why? Because issuing shares when they are undervalued destroys long-term shareholder value. He also explained a subtle but critical idea. Accounting profits are not the same as real economic value. In the Jordan's furniture acquisition, Berkshire chose an asset purchase. This reduced reported earnings due to amortization, but increased actual cash flow through tax savings. Buffett was explicit. He would gladly accept lower reported profits in exchange for more real money. Berkshire operates with almost no bureaucracy, no employment contracts, no budgets sent to Omaha, no mandatory presentations. Managers are trusted completely. And Buffett's rule is simple: treat them the way he would want to be treated. The result? He attracts a very specific type of operator, people who care more about autonomy and legacy than salary. The story of Bill Child makes this real. Child built a new store using $9 million of his own money. If it failed, he alone would take the loss. If it succeeded, Berkshire could buy it at cost. It worked. And when Berkshire took ownership, Child refused even a penny of interest. That's not incentives, that's integrity. Buffett then takes aim at Wall Street. He mocks investment bankers' pitch books, comparing them to Superman comics. Companies go in ordinary and come out with projections that can leap tall buildings. At the same time, those same bankers claim markets are too unpredictable to forecast their own earnings next quarter. The contradiction is obvious. Buffett's approach is the opposite. He doesn't chase deals. He waits for the phone to ring, and it rings because sellers trust Berkshire. Former partners recommend him. Reputation compounds over time. Finally, Buffett contrasts two investments: Dexter Shoe, destroyed by low-cost 4i, GN competition, See's Candies, a pricing power machine with approximately 24% margins. The lesson is classic Buffett. A great business doesn't need constant reinvestment to survive. It produces cash year after year. A weak business, even if it grows, can destroy capital. In 1999, Buffett looked out of touch. He underperformed, he avoided the hottest sector, and he warned that the boom wouldn't last. Within a few years, the dot-com bubble collapsed, and this D-grade letter became one of the most important case studies in investing discipline. Because what looked like failure was actually preparation. Warren Buffett outlines why stock market returns are mathematically tied to the overall economy, correctly predicting the brutal market crash that followed. Key takeaways. The 5% economic ceiling. Buffett ties corporate profit growth directly to the nation's gross domestic product, GDP. He projects 3% real GDP growth combined with 2% inflation, resulting in a nominal corporate profit growth rate of roughly 5%. The TIPS inflation gauge. To prove his 2% inflation assumption is realistic, he references TIPS, Treasury Inflation Protected Securities. He notes that TIPS yielded 2 percentage points less than standard government bonds, proving that a 2% inflation rate was the bond market's exact consensus at the time. The reality gap. Because corporate valuations cannot grow much faster than a 5% GDP growth rate over the long haul, plus a small dividend yield, Buffett warns that future stock returns will be dramatically lower than the wild returns investors had grown to expect in the late 1990s. Predicting the crash. Buffett accurately forewarns that when investor expectations inevitably crash back to reality, the market adjustment will be severe, specifically hitting the highly speculative sectors, tech and internet stocks. A wise man's view on mania. Refusing to participate in the dot-com speculation, Buffett targets cash accumulation over overpriced stocks. He closes with a famous lyrical quote to mock Wall Street commentators trying to justify tech valuations. Fools give you reasons, wise men never try. In this continuation of his critique on corporate finance practices at the peak of the dot-com bubble, Warren Buffett delivers a blistering attack on how stock buybacks are frequently misused by corporate executives to destroy shareholder value. Key takeaways. The ignoble motive. Buffett warns that share repurchases have become a fashionable corporate trend, often deployed for the hidden and ignoble reason of artificially pumping or supporting a declining stock price. The math of overpaying. While a propped-up stock price temporarily benefits departing shareholders, it actively penalizes long-term continuing shareholders. Buffett equates buying back shares at a premium above intrinsic value to buying dollar bills for $1.10. The perverse option offset logic. Buffett completely dismantles the common corporate justification that shares must be bought back to offset dilution from employee stock options. Because options are granted at low prices and repurchases are made at high prices, he mocks this as a cheerful yet economically disastrous buy high, sell low strategy. Independence of action. Buffett stresses that issuing shares for options or mergers and repurchasing shares are two completely independent events. A company should aggressively buy back its stock if it trades below intrinsic value, regardless of whether options exist. Conversely, it should never buy back stock above intrinsic value just because options were exercised. Quanwen. Admitting past errors. Buffett confesses that he has personally erred in the past by failing to repurchase Berkshire shares when they were cheap, either due to overly conservative valuations or being too enthusiastic about alternative investments. The short-sighted investor. He sharply rebukes shareholders who write to him begging for a buyback announcement just to make the stock price go up. Buffett points out that if an investor truly intends to hold the stock long-term, they should actually pray for the stock price to drop so the company can buy back more shares cheaply, which is the only way a repurchase program delivers real, lasting, math-driven value to continuing owners. This is one of Buffett's clearest math-over-narrative frameworks, and it pairs perfectly with your earlier segment. If the first half is Buffett underperforms but stays disciplined, this part becomes, here's the math that proved him right. At the peak of the dot-com bubble, Buffett did something very few investors were willing to do. He zoomed out and looked at the math. He started with a simple question: how fast can corporate profits grow over time? His answer was grounded in the real economy. About 3% real GDP growth plus roughly 2% inflation. That gives you approximately 5% nominal growth. And here's the key insight. Corporate profits, in aggregate, cannot grow much faster than the economy that supports them. If they did, they would eventually consume an unrealistic share of GDP. But in 1999, stock prices were telling a completely different story. Valuations implied that growth would be far higher than 5% and sustained for a very long time. Buffett pointed out the disconnect. Even if you add dividends, long-term returns should roughly track economic growth plus dividend yield, not fantasy. So if investors were expecting 15% or 20% annual returns indefinitely, the math simply didn't work. To support his assumptions, Buffett looked at the bond market. Specifically, TIPS, Treasury Inflation-Protected Securities. These bonds were yielding about 2% less than nominal treasuries, implying the market itself expected roughly 2% inflation. So Buffett wasn't guessing. He was using the market's own pricing to anchor reality. From there, the conclusion was unavoidable. If expectations are too high and reality is much lower, then one thing has to happen. Prices must adjust. Buffett warned that when this gap closed, the correction would be severe. And importantly, he pointed to where the damage would be concentrated: highly speculative, high-growth, narrative-driven sectors. In other words, the exact areas investors were most excited about. This is why Buffett wasn't chasing the market. He wasn't missing opportunities. He was rejecting bad math. Instead of buying overpriced assets, he was willing to sit on cash, accept underperformance, and wait. Because in his framework, patience isn't inactivity, it's discipline. Then Buffett turns to another topic that was just as misunderstood: share buybacks. He makes a very blunt point. Buybacks are only beneficial if done below intrinsic value. Otherwise, they destroy value. His analogy is simple. Buying back stock above intrinsic value is like paying $1.10 for $1.00. And yet, many companies were doing exactly that. We need to buy back shares to offset employee stock options. He calls this out as flawed logic. Why? Because options are typically issued at low prices. Buybacks are often executed at high prices, so companies are effectively selling low, buying high, and presenting it as shareholder-friendly. Buffett reframes the issue clearly. Issuing shares and repurchasing shares are completely separate decisions. If the stock is cheap, then buy aggressively. If the stock is expensive, then do nothing. Not complicated, but rarely followed. Part 16. A subtle but powerful insight, 2200-2300. He also challenges investor psychology. Many shareholders want buybacks because they think stock goes up equals good. Buffett flips this. If you're a long-term owner, you should actually prefer lower prices during buybacks, because the company can repurchase more shares and increase your ownership per share. This is one of those ideas that sounds simple, but completely changes how you think. Closing transition, 2300, 2400. By the end of this letter, Buffett had done three things: admitted underperformance, explained the math behind future returns, and exposed flawed capital allocation practices at the exact moment the market was most optimistic. He was the most rational. And that's why, when the cycle turned, he wasn't surprised.